Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet. All Bitcoin's going to be erased.
Bitcoin's the best crypto out there.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin not zero, and we have a great episode for you today. James Check from Checkonchain, one of the world's most intelligent on-chain Bitcoin analysts, is here to talk to us about what he's seeing in the market, what the on-chain data in the Bitcoin network is telling him about investor behavior as we dip down into the 70,000s and amidst this tariff and trade war. It's a great conversation. Recommend checking out James and that interview. And we'll check this week with our friend Connor Finemore, again, back to Galaxy Brains to talk to us about macro tariffs, treasuries, trade wars, and more. Before we get to all of that, I need to remind you to please refer to the link to the disclaimer in the podcast notes and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Let's hop right into the show. Let's go now to our friend Connor Finemore from Galaxy Trading. Connor, welcome back to Galaxy Brains.
Thanks for having me, Alex.
It's been an exciting time, obviously. I know our audience has been watching closely. The world has been gripped to the markets, to the televisions, to the truths from the president. I think before we talk really broadly, we're recording on April 9th, Wednesday, around 11 a.m. Eastern. Overnight, the treasuries, 10-year treasury, rose from, all the way as high as 4.5% yields. That had a lot of people spooked. It's come down a little bit. There was some chatter that perhaps like the basis trade is unwinding. No one, it seems, really knows. What's your take on that?
Yeah, I mean, I will say that firstly, I'm definitely from the equity side of the world. Unfortunately, BIMNET's probably the perfect person to ask this question. But I think that a lot of the fear from the price action is who's your seller, right? Is it foreign governments that are trying to use this as a weapon of negotiation? Is it broad deleveraging in the U.S. financial system? Is it the fact that as firms sell equities in their margin accounts, that the offsetting treasury needs to get sold? So just general deleveraging in other parts of the market. Because each of those outcomes or each of those drivers has a different level of fear to it, right? And the biggest one being foreign governments, really China, and maybe some of our closer trading partners like Japan being big sellers. That spooks some people. On the flip side, there is some conversation that some of the selling is coming from very friendly nations like Switzerland, who may be selling long end treasuries to buy the dip in equities, right? They view their central bank management a little bit more actively, and so that might be something to be less concerned about. But definitely over the last 4 days, the size of the moves, and even the size of the intraday moves on Friday, tens had moved 20 basis points and finished the day basically unched. It's really hard to do anything in that environment.
Yeah, you had pointed out that something like the Thursday, Friday, Monday, Tuesday was the longest streak in intraday 5% moves. Was that right?
Yeah, so it's the 4 days in a row in the S&P of 5% intraday moves. There are 4 periods in history that's happened. 1987 crash, 2008 crash, 2020 COVID, and the last 4 days. And so I think when I was on the podcast with you last, the two main market thoughts that I had shared were that I thought index vol was cheap with VIX at 17, and I thought that crypto would trade with equities. And I'm gonna say that VIX is north of 40 and has been for the best part of a week. And unfortunately, crypto has been trading with broader risk, which is a function of positioning. It's a function of where do you hide? It's a function of hedging my book. And so, Bitcoin here is at 77K, I think, when I walked away from my screens, and it could be a real, come to terms moment with Bitcoin with gold up 3% today, which way is Bitcoin going to trade over the next 12 months? Are we going to trade with gold, or are we going to trade with risk assets?
Yeah, it is a big question. And you can imagine, I mean, I've been talking about this for years. You can imagine that if you are, let's say, a foreign government or a foreign person looking to find a store of value, gold is good. It works. It's old, but you can't move it. I mean, to me, that's the core issue with gold, right? It's not transportable at scale. So you can't move $1 billion of it in 10 minutes around the world like you can with Bitcoin. I wonder if this will be the time. I do believe on a long enough time frame, eventually the world will agree with that, and Bitcoin will be a gold-like non-sovereign store of value. But I agree. This is a time when it would be great if the world had that as an outlet and agreed upon that as an outlet, and it hasn't yet. But at 77,
I think non-sovereign's the right point, though.
yeah,
I mean, sovereigns can hide in gold all they want, but if you're an individual, you've got to have your money in something.
yeah. And you can't have like giant, piles of gold bars under your bed. It's just simply not going to fit.
Right. And we're fortunate in the US to have such a strong legal system that it's part of the reason that our assets are so valuable. But in the event that there's some deterioration of that, where do you go? Where do you hide? And so that could be sort of taking it back to rates and to tens for a second. That could be part of the reason that we have seen a sell-off in the back end is people globally, not Americans, people globally are saying, maybe this isn't the safest place for my money anymore. It's a scary thought, and it's probably way too early to be having that conversation, but we're reacting to the price action that we have.
Yeah, I think it makes sense. I mean, you buy treasuries or sovereign debt. It's partially a bet. It's significantly a bet on the ability of the sovereign to be stable and pay the debt off. And I would say it's fair to look at United States policy at the moment and say that it doesn't look stable, right? I mean, that doesn't mean it's going to, collapse. That's the end of America or anything. But in this moment, there's so much uncertainty. What do you make of the uncertainty on trade and tariffs?
No, I think that right now there are different factions within the Trump administration that have different stated goals. And I think it's the first real ideological point that they're clashing on, right? So you've got Bessent's 333, 3 million barrels of oil, 3% deficit, 3% 10 years, right? You've got Musk, who wants to cut the deficit with Doge. He's got his own business interests. He actually manufactures a lot of things in the U.S. and has been a very pro-U.S. Manufacturing investor for a decade. You've got Navarro as a China hawk, and then you've got the Cass, Mirren, Miller, American worker, American exceptionalism, protectionist thing, right? And those can't all exist together, right? The reality of tariffs are we're going to have real growth slow down, and we're going to have inflation higher. And that dynamic does not fit with cutting the deficit, right? Because you raise revenues from GDP and you pay your costs at whatever the market rate is. And so it's really hard to square those two things. And there is going to be a point where something has to change, right? The Trump administration wants to raise revenue with tariffs. So in their minds, that's meant to help the deficit. But part of the story that has been told is that we are going to grow our way out of this problem. And it's degrowth by nature. And you can look at the copper price, you can look at the oil price, you can look at stocks. All of these things are trading degrowth. And so that's just, there's something that has to change in that environment. And I don't know if it's, doing a really good deal with your allies, getting Europe to spend more on defense, getting Japan to, close the trade deficit some, trying to negotiate with those counterparties and then working on China later. That seems to be the natural path forward, where it's the least saving face, I guess, way to do it. But it's really hard. I think we're all asking the same questions, and anyone that's very confident in what the best way forward is probably overconfident.
Yeah, it's really weird to think back to Liberation Day last week, and and look at the tariffs that were imposed or announced, which were really, some math around the actual just trade deficit. And I get it. The president has been a critic of our trade deficits and import export ratios for decades. But you have the reciprocal tariffs on one hand, whether they're monetary or non-monetary trade barriers. That sounded okay. I feel like the market was pretty well conditioned to accept that after several months of drumbeat. And that may be unfair, but when you look at the trade imbalance and call that unfair, isn't that literally the price we pay for exporting dollars around the world and being the global reserve currency? It's not just the price. Isn't that the deal we agreed to?
Well, and we like to be consumers. I mean, it's great that I get to sit at my desk and eat Mexican avocados and drink mango smoothies from India and use technology that's manufactured in a dozen countries before it gets in front of me for less than $1,000. Like, for the consumer, all of those things are great, and shifting supply chains will make all of those things more expensive. So, the American ideology really revolves around that consumption. That being said, I think a lot of the ideological reasons behind why the deficits exist in the first place and why Trump wants to change that, being that he thinks that globally people have taken advantage of the things the U.S. offers, which is defense, which is a super fair point. It's just, I mean, and 100 other people would have said this. It's just the manner that it was done in that is, it's too inflammatory, right? Australia is such a great example. They are a trade surplus, right? They buy more things from the U.S. than they sell to us, and not only that, the goods themselves, they buy military equipment, aircraft, complicated machinery, farming machinery, and what do they sell to us? Steaks, lamb chops, iron ore. I mean, these are things that we love, right? And so, not only is it one of our closest allies, a security interest for us because all sorts of military equipment exists there. They're a trading partner that, in Trump's own framework, is a positive trading partner. They still get a 10% tariff, and credit to them. Their basic plan is, we're not in the top 10 priorities, so we're going to sit quiet and try and be as helpful to the Americans as possible while they deal with everyone else. So they'll probably work out just fine. But I think it's just a good example of maybe there are places where this could have been executed better.
Yeah. Last question here. What do you think is there a breaking point? Do we need a deal, a major breakthrough deal that then the Trump administration can point to and thus either secure more deals on the back of it or back off, take their foot off the gas, or and that maybe that's the optimistic case. The pessimistic case is there a level on the S&P or in the other direction on treasuries where like they have to change policy? Like where's the Fed put, where's the S&P put here that's going to tell the administration that they've broken too much, or is there one in your mind?
I mean, I think there's probably a level in 30s where Powell has to stop balance sheet runoff. That as a bare minimum. I think probably there will be a level where, mini QE, like mini bank crisis 2023 type policies can come in, some sort of emergency facility, just so that everyone is comfortable that liquidity isn't going to be an issue. There's not a lot Powell really can do because moving the front end doesn't help a ton here, right? It's one of the sort of points that I've tried to hammer on the desk. When you have degrowth and inflation, cutting interest rates doesn't help. And so, there's limited things that Powell can do, but they're probably low-hanging fruit. So if we spend any meaningful time above 5% in 30s, I think that, they'll stop balance sheet runoff at the bare minimum. In terms of S&P, no. I think there are levels where people will start to look past this, but that I think will be the main lever to watch, and will continue to be very volatile. And I think that, implied vol levels in equities are probably fair and will be sticky. Yesterday, actually, when we had that rally in the morning, people sold vol aggressively, and all of those people got smoked on that because we rolled, 6% intraday. And so today, again, we've had a small sort of drift higher in equities, but vol has stayed very firm. And that will probably be the environment. And then on the deal making part of the question, I assume that we'll get something from Europe that's positive soon because the Trump admin needs a win soonish, and the Europeans need to move their energy supply chain. So like something like a big natural gas deal between the US and Europe seems like a very like beneficial for everyone, probably was going to happen anyway type deal to sort of cool off that relationship. I think something from Japan and South Korea is going to come soon because they realize how close they need to keep the US with China as the global threat. I don't know what's going to happen in China. It's really hard with like 104% or 113%, whatever the number tariff is. It's probably up 20% since I sat down here. I don't really know how you trade in that environment. So part of me wants to say because it's so hostile right now that it has to change, but maybe they both dig in. I really don't know.
Yeah, well, no one really does yet, and we're beholden to the headlines at the moment, right? That's where we're all watching, and hopefully we get some deals here so that all sides can take the temperature down.
I agree.
All right, my friend Connor Finemore from Galaxy Trading, thank you so much.
Thank you.
Let's go now to our friend Checkmate from Checkonchain. Check, welcome back to Galaxy Brains.
Thanks, mate. Thanks for having me on.
It's quite an exciting time to have you on. I was thinking about who to talk to today about what's happening in markets, and you were the first person that came to mind. I'm a subscriber to your awesome newsletter and content at checkonchain.com, and you wrote a great piece on Monday called Top of the Chop. What does that title mean?
Yeah, I love writing the titles. It's one of my favorite things in my process preparing these pieces. Top of the chop. So the chop solidation range, which I think was another word that I coined back in 24, that's a zone that's been on everyone's radar because I view markets as they're a confidence machine. They're trying to find out where did supply and demand meet in the middle and come to some kind of agreement, say, you know what, Bitcoin is worth this much, whatever the asset is. And in this case, that 2024 zone, the way I think about it, in 2021, we tried to get above $1 trillion because like 1.2 trillion, 50, 60K, and the market said, no, not time, back down you go, 50% the first time in mid 21. And then we had the 22 bear market. So it was a rejection saying, sorry, you're not ready yet. We spent 8 months chopping around, and every time it went below $1 trillion market cap, the market bid it. Went below 1.2, the market bid it. German government sells 50,000 coins at $1 trillion market cap. Market says, thank you very much, pushes it higher. So the way I look at it, that's the last time that the market had a really confident level to say, you know what, Bitcoin is worth this much. Now, obviously, you mentioned it's an exciting time. What a period of time that we're living through, right? The world is changing in very, very big ways. And I'm writing a piece at the moment to just try and consolidate my thoughts. And something I've got in there, as I said, there is no undo button for what's just happened, right? This is a little bit like the Russian reserves being frozen. We are watching something kicked into gear. It can't be easily walked back. So therefore, the market's going, well, where do I go I don't know what this thing is worth anymore. I don't know where the world's going, what comes next. So top of the chop, it's been this zone of interest for a long time of mine. 75K is kind of the top of it. And that is just the area where the market previously had confidence that Bitcoin was worth that much. We've backfilled what I've been calling the air pocket, 86K to 75K. No coins transacted on the way up. We're now backfilling it to say, well, okay, bulls, you liked it at 100K, you liked it at 90K. How do you like it at 75?
Yeah. The air pocket was the catapult that we had in Bitcoin price right after the presidential election in the United States, right? It was ripped higher all the way to the, up to the high 80s and then the 90s with almost no transactions at all. So, and yet you've been calling that out since December, I think.
Late December. Eyeing an air pocket was that piece.
Yeah. We're talking about the URPD chart effectively. Like there were no Bitcoin supply that had moved on chain between the prices of 74 and 88 or so.
It was about that. Yeah. 86 was the top of it. Yep.
Yeah. So how do we? What does that tell us? And you're talking about the confidence game, seeking out those bid and asks, right? The market trying to hunt them down. Is that sort of what you see happening now with that air pocket? Like, so we have to. It's almost like filling a CME gap, right? Like we have to go back and see if there's real demand there.
Yeah, it's the same energy. And I've got a lot of questions asking me, like, why does the market go there? And like, honestly, I don't know. It just does. It's just one of these things. I've been in markets long enough that when you get these really big, obvious signs, and in that post top of the chop, there's a saying that I've borrowed from my market mentor, Doc. And he basically said that in a sea of sand, a single flag becomes a target. Imagine you're out there in the desert. It's almost like on Tatooine, when C-3PO and R2-D2 gets shot down, they're like, where do we go? And they see that little thing pop up. Right? Turns out it's the enemy, but it's the only obvious thing to go to. And in many ways, it's a shelling point. It's just an obvious place that everyone's going to go in times of distress when they're like, hands off, I don't know. And that chop consolidation rate, it just felt like something that the market wanted to test, wanted to find out what was there. You can do all sorts of technical analysis. You can do on-chain analysis. The Fibonacci levels line up with these zones. It's a really obvious magnet for the market to say, show me what metal you got.
Yeah, it does. I love that idea that in, a sea of sand, of an abyss, right? You're going to gravitate. It's human nature to just go to that one outpost that you can see. And it does feel like that because Bitcoin's now like 33% down from its all-time high or so. S&P 500 is down over 20%. I think it was about 22 the last time I checked. We're recording on Wednesday, April 9th. And Bitcoin moved earlier, right? And I feel like that was sort of set up at first by sort of Bitcoin and crypto market native catalysts, sort of the sell the news on the inauguration, the Trump coin, right? The sort of sucking of liquidity out of the altcoin complex, and then sort of the anticipation of the SBR or any of these other positive regulatory catalysts that haven't actually fully developed yet. But all that anticipation, right? How much you think there was a lot of froth and anticipatory froth following the election? People trying to price in how bullish are we meant to be?
Yeah, no, it's been a really interesting dynamic. So one thing that I described for quite a long while, and to be honest, it was remarkable it held up as long as it did. December to February, we were seeing tens of billions of dollars of old coins moving every single day, right? And it was one of those times when, to me, it was amazing. We stayed up at 100K for as long as we did. And then you go and look at the 13F filings, you look at the ETF flows, you're like, there was genuine, serious demand. I'm also quite impressed at how little the ETF outflows have been. We did see about 4 or 5 billion just kind of leading into at the start of the sell-off. But when you model that against CME open interest, they declined by about the same amount. So to me, that was telling us that we've actually had a reduction in the carry trade. There's fewer traders who are putting that position on. There was a bit of an unwind there. And the way I look at that, if you've got a cash and carry trade on, you have to sell the ETF and buy the future to close that position. And the ETFs are far less liquid than the futures market. So the futures market can absorb it, whether you're buying or selling, far more liquid. But if you're selling, 4 billion worth of Bitcoin, and there's $2 billion worth of trade volume on the ETFs, it's market neutral for the trader, probably not so much for the market, right? Still got to absorb those flows. So we saw quite a bit of outflow, and it's really softened. So I'm looking at this and if you told me that the S&P would be down 5% 3 days in a row, right? Nasdaq's down 6%. I'd be saying Bitcoin's down like 30% from wherever we were, but we're down 30% from the all-time high. So you're right. It's priced in earlier. It's gone first. It's gone faster. I'm actually surprised, even though Bitcoin's down, it could certainly go lower. I'm actually amazed at where it stands, relatively speaking. And then I also have, I've always got an eye on gold. And gold is, it's down from its peak, but it just ripped to a brand new peak, 3,100, right? 3,150. It's still trading above 3,000, $3,050. So I just think there's this interesting dynamic playing out where, yes, people are selling things, and yes, the world's in a bit of a kind of a tumultuous spot. But again, you explain these scenarios to me and say, what is Bitcoin doing 6 months ago, 12 months ago? I'd say it'd be wrecked.
Yeah, I agree. I mean, the amount of tumult is significant. And I see gold is right now, as we talk on April 9th, trading at $3,076. It's up 3% today. So people are fleeing to gold a little bit. Yeah,
Yep.
and I agree. I mean, Bitcoin right now, as we talk, is almost 78K. I mean, it's not it doesn't down from 109. So is a lot, but 70. If we joked a couple years ago when we'd be crashing to 78K, like that would be pretty funny. Nonetheless, you pointed out the short-term holder metric, which is coins not moved on chain for the last or that did move on chain within the last 155 days. Basically completely underwater at this moment, right? No, there's nobody. There are no coins that fall into that cohort that are currently above 70. I mean, maybe it's probably reset since you wrote this on Monday, but a little bit. But what do we have to do to get those coins back into profit? And how do we form a healthy base down here?
Yeah, totally. So this is one of these interesting dynamics. And every so often in every cycle, there's a couple of points in time where we use the long-term holder, short-term holder cohort. Lots of people like to debate around, but 5 months isn't long enough. It doesn't actually matter because statistically speaking, once a coin's been held for 5 months, it statistically has the same probability of spending as any other coin that's been held for 5 months. And that is much lower than any coin that's moved more recently. So, we can all debate around whether they're hodlers or not, just call them red coins and blue coins. The red coins, which are short-term holders, those ones tend to be the ones that capitulate. They buy the top, they sell the bottom. They're very, very mobile. Now, on this sell-off, prior to this sell-off, we had 50, if you can believe it, 52% of all dollars, if you price every UTXO from when it moved on chain, 52% of every price-stamped dollar was above 90K as a cost basis. An incredible statistic. And that just shows you how much of that long-term supply came back to the market, moved from a price of about 70% of the coins came from the chopsolidation range. So people bought at 50, they sold at 100, someone bought at 100, and those guys are now underwater. Now, in these processes, obviously, as the market sells off, 5 months ago, we were pretty much on the ascent. So if you go 5 months ago, somewhere in November, we're climbing up that stint. So basically, everyone who bought after the chopsolidation range is a short-term holder. Everyone before that, long-term holder. So it's a nice little delineation.
Yeah, it is helpful now that we are time-wise where we are, because we were in that chopsolidation for 237 days between March 2024 all-time high and November 2024 all-time high. And, that was a volatile. I mean, we ranged, I think, as low as like 48K at one point during the Japan carry trade.
And that was the
unwind.
deepest correction that we've had until now. So now we've got, I think it's 33. Back then it was 32 and it was for like 4 hours. Now we've got a meaningful correction from the highs.
Right. And when we look at those corrections, you were saying, interestingly, it's not in the context, it's not actually that irregular. There were several in 2017 and at least, one of significant, I guess it would be the China ban of Bitcoin mining and the Tesla not accepting Bitcoin in 21. Just gut, and I know it's tough because the macro is so dominant right now, but is the bull market over?
It's a great question. And the way I'm looking at these things, there's going to be people who listen to this and go, this is a cop out, but I'm actually, and I'm contemplating in my conclusion for the next piece, just saying, I would recommend people just put aside the notion of bulls, bears, and cycles for now, simply because the macro is in the headline. And Lynn Alden's been saying this, it's a headline-dominated market. Things can change on a dime. So you can imagine, just think about the scenarios. You could absolutely have the market deteriorate. We could have a recession that comes out of all these tariffs because there's just so much uncertainty. Businesses don't know how to order. They have to, lay people off. There's all sorts of things that can happen. And then the next day, the Fed can come in and start doing QE because it just gets so destructive, right? It'll probably go lower before that happens. But you're in this environment where things can just reverse on a dime because of, what's the saying? Markets panic when politicians are not panicking. And I would say that's where we are right now. The politician, you look at what's going on with Trump, he's not panicking at all at this point in time. But there will come a point when they have to panic because things start to deteriorate. And at that point in time, markets feel much more confident. So for me, I think it's one of those things. I would put aside the notion of bull and bears, put aside the notion of cycles. We're in a headline-driven environment. Things are going to be super choppy, super volatile. It's going to be really, really hard to read. And I think the best analysts in the world cannot tell you what happens tomorrow because we just don't know what Trump's going to come out and say. We don't know what Xi's going to come out and say. It's crazy.
Yeah, the tit for tat is getting pretty extreme. And the other thing that I've been thinking about a lot is U.S. government debt, and one of the 4D chess thesis corollaries, right? The idea that the turmoil is intended, right? It was intended to push people into bonds, lower the yields, and then longer term we could, or medium term we could refinance debt at lower interest rates. I think one of the things people have been very afraid of overnight has been the 10-year rose from 3.8% to as high as 4.5, which is an astronomical move in extremely deep liquid markets like treasuries. If that means, if the rates are rising like that, it means people are selling bonds. And there's some debate about whether there's countries doing it or whether it's this hedge fund carry trade unwind, a very popular basis trade unwind, very popular trade among the world's largest hedge funds and banks. But if people are fleeing, I'm looking at DXY around 100, so the dollar isn't like super bid. If the debt yields are rising, they're not super bid. Gold is up. I mean, gold looks like a decent safe haven at the moment, but stocks are down. Like, are people just buying cash? Are they selling things and buying cash? Or like, and as the corollary to that question, like, is there a time when people realize that gold is good, but you can't send billions of dollars of it around the world in 10 minutes? Like, shouldn't Bitcoin be getting a bid at some point in an environment like this?
It's a good question. And I use this framework to think about these things where there's like the gravity of the situation. If you just left the system to its own devices, what would be the result? And then there's the managed outcome, because usually if you allow the system to go to its natural course, stuff breaks and they've got to step in and do something about it. So the way I'm looking at the treasury rates, I mean, of course they're going to go higher, because why would you lend money to any of these governments? It's crazy, right? It doesn't make any sense. So when I look at it from that perspective, whoever is selling, you mentioned like it's supposed to be the most liquid and deep market. I think when you get moves like that, it's telling you it may not be so liquid and it may not be so deep, right? It's not able to handle these kind of flows. So if the bond market is and that's the one asset that's going to call time on this stuff. And for want of a better term, I put out a tweet a little bit provocative the other day that just said US equals EM, which is basically saying the US is starting to trade a little bit like an emerging market, because when you go into a recession, you go into a downturn, there's any kind of stress, people will pull their money out of your bond market because they know that you're going to have to do a hell of a lot more fiscal stimulus to prop this thing up. And they don't want, like, 3.8% is just not enough. And then I was just contemplating, this 4D chess. Who knows whether it is 4D chess? I'm struggling to get my head around that thesis, because if you're crashing the economy in order to get people to buy the bonds, at some point in time, like, you're just not going to get that many buyers into that kind of environment. That feels like I don't know, to me, it feels like there's more and more of these investors saying, you know what, I actually don't want to hold the paper. And to me, it looks like you're going to have to do more. The QE is going to have to come in to stop this, arrest this fall, which means I'm not going to get back the dollars that I'm owed. If I buy this bond at 3.8, I need 4.5, I need 5. And at some point, they've got to come. We know 5%, 4.5 to 5 is where they've hit stress before. Back in 2023, yields were spiking, and that's when Janet Yellen flipped over and started doing short-term paper. So we know we're in the stressful zone. And, I've heard an interesting saying, at a time like this, maybe people actually move back into equities because at least they know that Apple's going to be able to service their debt.
Yeah, it makes sense. I mean, it is tricky too. Yeah, trying to buy sovereign debt while you're concerned about the behavior of the sovereign doesn't make a lot of sense necessarily. Back to Bitcoin, you were talking about a reversion to the MVRV mean, similar to the lows in 24. So this is the market cap to realized cap ratio. And maybe explain what this means, because, you said that these metrics, the short-term holder, the MVRV, what was the AIV, what's that one that you like? Instead of more than
AVIV.
AVIV.
I can explain the details of it. Yeah.
Yeah. Explain those details. But also you're saying most of these, the Mayer multiple, they're all sort of showing that we're like in a bottoming scenario, at least on chain as it looks at the moment, relative to other periods of bull market.
So the way I'm
what are
looking
those
at this,
telling you?
Yeah, so these are just a series of oscillators, and why I like things like MVRV. So the way to think about MVRV and same as AVIV, they're all lots of jargon, but essentially they're an oscillator showing you how in the money the average investor is. If someone bought it $100 and the price is trading at 200, their MVRV is going to be 2, telling you that they're up 2x. So it's looking at the average investor. MVRV looks at the average coin. So it includes all the lost coins, includes Satoshi, everybody's in there. My preferred version, which is something that Dave Puhle and I developed 2022, I think, in a framework called Coin Time Economics, we came up with a different model to the realized price. And what we're trying to do is solve that problem of like Satoshi's in like tens of billions of unrealized profit, which means to be at break even, some other poor guy is going to be down tens of billions on his holdings, right, in aggregate. So what this does is it tries to filter out lost coins. It looks at how dormant they are, puts them aside, and says, let's look at active investors. So from my view, that's really a much more sensitive model. But anyway, across the board, whether it's those profit and loss ratios, whether it's looking at the Mayer multiple, just literally ratio between price and the 200-day, all of these are at a level where in this cycle, and I think this is where it's important to just think about each market dynamic is unique. Back in 2017, very adoption-driven, very organic, very retail, 100 times smaller than we are today. 2018 to 22 was a very, very volatile period. Booms and busts. We went straight up, we went straight down, straight up, straight down. And all of these oscillators, you can see it in their amplitude, really big moves. Since 2023, there's a new rhythm. The market's trading in a new rhythm. We can see this in implied volatility and realized volatility. Bitcoin is trading differently since 2023. So let's just call that. I would actually say, if we're going to talk about cycles, up to 2017 was an adoption cycle. 2018 to 2022 was a maturation or a development cycle. Derivatives come on board, stablecoins come alive, the market changed. 2023 onwards is an institutional cycle. We have a different type of marginal buyer now. And all of these metrics have, to date, bottomed in this type of area. Now, that also, we have to always think in scenarios. If the market wants to, if the bulls want to prove that they have the metal to actually keep this thing going, we really want to be hammering out a floor in the 70K region. We don't want to be going too much lower. Getting down to 65K, that's where that true market mean is. At that point in time, your average Bitcoin holder, not just across the board, people who are in Bitcoin, they're going to be on there like real sensitive. If it goes lower, I'm down on my position. MicroStrategy goes below 67, down on their just net position. And, that's not saying that anyone's going to go insolvent or blow up, but investors respond. You can imagine it. Get to 65K, the average guy who's been in this market for 5 years, 6 years, is underwater on his position. The sentiment's going to take a hit. So the bulls need to mount a defense here. If we keep going lower, which we of course can, things start to get increasingly hairy, and it actually raises the odds. If we rally, and we'll get a rally at some point, you start setting up lower highs, right? Because more of those short-term holders go, you know what, I'm going to get out of this thing. I'll take 85, I'll take 90, I'll take 95, whatever the price is. I just want to create resistance because I want my money back.
Yeah, that makes sense. I think the last thing we want is the headline that says, Michael Saylor is like net down on his Bitcoin position. I think that is going to create some
at the
fear
same time,
in the market. Now,
that's the kind of headline that puts a floor in, because you can almost imagine the pain, the fear, that's the kind of thing where Bitcoin there'll be obituaries coming out everywhere. We'll add a bunch of more dots to that obituaries chart. And that's the kind of fear that you usually need to put a serious macro bottom in.
Yeah, you're right. And I remember in 22, people were worried about MicroStrategy, now Strategy. They had a loan at Silvergate, I think, for $500 million off their Bitcoin. And people, like when Bitcoin was like 20K, 18K, after FTX's collapse, were like, oh, what's Saylor's liquidation price, right? And it was like, well, it's probably like $3,000 of Bitcoin price. And also separately, he has an enormous pile of collateral to collateralize that. They don't have similar types of loans today. They have debt that they owe, convertible debt primarily. But none of that I'm aware of is due sooner than 2 years from now, the maturity on that debt. So there is no specific clear risk in my mind to MicroStrategy at the moment in terms of, but yes, the headline risk. And I suppose the other risk would be if their stock traded at a discount to their Bitcoin NAV holding. So it's been trading at a premium. But if it traded at a discount, I suppose they could seek to buy back their stock. And then you have to ask with what cash. So it gets, but anyway, I do think that's overblown. It's the headline to me is the real question. And But it almost feels like that Schelling point you're talking about with the air pocket, where it's like, it does feel a little bit like the market might want to try to hunt that out and see what the reaction is.
Don't exactly. Do not have it as a zero probability. That's the kind of thing where the market will go and test those levels. And I agree. Like I think Michael Saylor's brilliant, right? So he's gonna understand his capital structure. I don't think he's gonna, the liquidation headlines will be there. That doesn't mean that that's going to be what's going to happen. And for me, something that I'm actually very curious to see, because I've wanted to see what happens to strategy and how it trades during a bear, so I can properly understand the dynamics. And what I actually want to see is, what does he do? Does he go back and start buying his stock back? How does he raise cash? What are the opportunities that he has to actually raise money? Because a comment that I've had in the past, and it's an interesting one to think about, the business is structured in a way where they specialize at buying high. They can raise the most money when people are excited, euphoric, the energy's up, Bitcoin's rallying, MicroStrategy's rallying, he can sell the most stock, he can raise the most debt. It's much harder for him to do that in a bear market. And I've had some of the MSCR bulls say that he'll be able to raise money in the bear just via different methods. I'm actually excited as an analyst. I'm curious to see, how does he handle such an environment? What does he do? Can he actually raise money and buy Bitcoin at discounted levels? Maybe the preferred stocks are the tool he has available to do this kind of thing. So for me, I'm very curious to see what tools he can play. And it's a fascinating dynamic, and the market is going to test these levels. It's just what it does.
Yeah, I agree. I'd be very interested to see. And he has, he said, I'll be buying the top forever to Laura Shin on that famous clip. And that actually is pretty much true. That's when they can buy the most. And you see that in their buys. James, before we wrap, you're not down under like you usually are. You are in Bedford, UK right now. Is that right?
I am, and I've brought the sunshine with me. I've been in Ireland and the UK for 2 weeks now, and I've had 1 day of rain, and I've several days of just clear blue sky. It's fantastic.
Well, I'm excited because it's Pete McCormack's cheat code conference this weekend. I will be there. I'm getting on a plane tonight to fly, and I will see you in Bedford tomorrow. So probably for dinner tomorrow. So if you're in the UK and you're on the fence about attending cheat code on Friday, you should definitely check it out. Just Google cheat code conference. Great Bitcoin conference. And I think we have a league final for the Bedford Pirates football team on Saturday. And on Sunday, the women's team also playing in the final. So I'm quite excited about it. Looking forward to see you there.
No, absolutely, man. I'm really keen. I think Pete's doing a really good job down here, and I'm just keen to see Royal Bedford and get myself a jersey.
Yeah, let's go. Well, thank you, James, our friend James Check from Checkonchain, for the update, and have a great one. We'll talk to you soon.
Thank you, mate. I'll see you soon.
That's it for this week's episode of Galaxy Brains. Thanks to our guest James Check from Checkonchain and our friend Connor Finemore from Galaxy Trading. Everyone have a safe and happy weekend, and we will see you next week. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXYResearch. See you next week.